we want people to be able to work through it. We'll also have people coming on board during the course. This is a very expedited course. It's not a lot of lecture slides. The discussion and the issues and questions that you may have for your particular company, we'll have time to begin to address some of those. Hi, I'm Ray Moore, Renard Moore and Associates. Been doing this about 35 years, and there's a bunch of ideas and concepts that I've used and we'll talk about today. I actually have had a chance to not only run the management consulting firm of Renard Moore and Associates, working with GCAP over the many years, but I've also been able to teach at UCLA Graduate School of Management and through their extension program, as well as other universities here in Southern California, on these very same topics. So I've kind of seen it from both sides. I've also been a senior member of a small business, been on the corporate side, and also on the consulting side. Caltrans and GCAP. And GCAP is my partner, Prime, that was working with on this services contract here with Caltrans. And Caltrans is offering these services to outstanding companies like you guys, simply to get more opportunities to bid and participate in highway construction projects. Well, why don't we talk about some financial statements. Disadvantaged Business Enterprise, DBE, Supportive Services Program, of which my firm is in conjunction with GCAP, and it's done through the auspices provision of Caltrans. And what we're doing now is that we're going to go through what financial statements are. We're going to talk about the format, how you set them up, and most importantly, how do you understand them. And then there's some financial calculators that give you some ratio analysis that you can use to help monitor the health of your company. The good news about that is that it provides an opportunity to really measure how you're doing. A lot of you feel, well, if I have revenues, I'm doing fine. Well, that's part of it, but you got to look at the cost side as well. One of the things I've heard now is that everybody is somewhat newer to the idea of how these accounting financial statements integrate into decision making and the creation of data that others can use in monitoring your business, approving, etc. What my understanding is that because you're somewhat new, these additional slides may help a bit in terms of understanding exactly how and why these financial statements become such an important part. And this is the actual slides we go through. It's the same format stuff, and this is my information. I'll pull it up again. This is the best example I've seen over the 35 years I've been doing work on why financial accounting statements are important. It's a very simple reason. Very simple reason. One, if you were the evaluating party, let's take an example. If you were a doctor and the party you were evaluating is a patient, what would you do? You'll go look at their pulse, you'll look at their temperature, and then there's a whole host of things that doctors do to determine if you're okay. If you're a stock investor and you're in the stock market, what would you look at? You look at the stock index, you look at the consumer price index, and there's a whole host of indexes and financial information and the Bloomberg report. There's a whole source of information that spends a lot of time analyzing the status of every component in the world regarding the stock market. Well, let's talk about your situation and how you in business are impacted. If you're an investor or a lender to a company, how do you tell if the company's doing well? Well, the way you tell is through their P&L, through their balance sheet, and basically through their cash flow. Those are the tools, or what I often call, that's the report card. The financial statements are the report card of your company. And in fact, the accounting is the language by which your business report card is provided. Okay? Simple. And that's why there's so much attention to these kinds of elements. So how do you measure your health of your company? Well, You got to know your legal position. There's all kind of issues these days about legalities. You have to be a good corporate citizen. Yeah, not only do you have to perform your service, but you have to do it in the social context of the community of which you participate. Your P&Ls, your revenues, your operating costs, your write-offs, how are they? What are they? Are they high? Are they low? Your balance sheet, your current assets, fixed assets, current liabilities, long-term debt, equity, your capital investment. Each of you as owners of your company have spent time and money, cold cash, to get your company to the point where it is today. You may even have outside investors. And then, of course, cash flow. Just very simple. I just want to say balance sheet, and we're going to talk more about it. It's a numeric addition that your left-hand side of the balance sheet equals your right-hand side. In this case, total assets of 14 equal total liabilities and equity of 14. Those two always balance in the balance sheet. So in the current assets and fixed assets are the two components of total assets. Current liabilities and long-term liabilities. Current is usually under a year of debt, that is due within a year. Some people make it shorter depending upon the company, 30 days. Long-term debt is longer. Those two add up to your total liabilities, and then plus what you invest in the company. In this example, 8. The 8 and the 6 add up to the 14, which equal the 14 of assets. What's most important to me is that you understand how these kind of principles relate to your business. And in fact, your business may be at the beginning of these kinds of thoughts and issues. They may be toward the end in the sense that you have it under your thumb. But it's important that you understand how to apply this, because it applies to whether you're Exxon Corporation or whether you're the mom and pop store on the corner in your neighborhood. So let's dive right into it. There's 3 main types of financial statements: the balance sheet, the income statement, some people call it the P&L, and the cash flow. Very simple, because what it does, it allows you to get the temperature like a doctor can of a patient. They actually measure different elements. One would be like taking your temperature. The other one would be like taking your pulse. Another one would be like taking your blood pressure. So all are important, but they're different. Now, I mentioned accounting is the language. What governs this is what they call generally accepted accounting principles. What happens is the government's gotten together and said, okay, if everybody uses the same ruler, when you do your financial statements, I can compare company A to company B. And that's what's so good. And they call those generally accepted accounting principles. And all of your CPAs spend time learning those. They're the guidelines for the financial statements. They use a double entry accounting system, and it just allows for a good comparison of one company to the other. As we just mentioned just briefly before, the balance sheets, there's 2 components. The assets equal your liabilities and equity. On the left-hand side of the balance sheet are your assets, and then on the right hand is the liabilities and equity components of your business. Liabilities are simply another word for the debt. There's a short and a long term. The equity is essentially the dollars you put in net to your company out of your own pocket as the owner. And it could be multiple owners. It doesn't have to just be one. It's a snapshot in time. It happens as of December 31st, 2016, or some given date. An example of your assets can be your current assets, which are used, and people vary on how they want to set that, but surely within 30 days, any value that you can pull out, like cash, you can get your money there in 30 days. Some people say prepaid expenses. There's a whole host. It really depends on your company. There's some general guidelines, but basically, can you get the money quick? There's investments. Sometimes as a company, there's extra cash, you put it into a savings or something. property, depending upon the size of your business. You may have a building, you may have equipment. A lot of you are service companies. Architecture and engineering companies tend to be service-oriented, so it tends to be office equipment and so forth. But you could be a surveyor, and there could be a number of things that are major assets. And for construction guys like AJ and those, either you lease or you own major construction equipment too. So that's your assets. And then your liabilities, once again, are your current liabilities, short-term debt, and your long-term liabilities would be your longer-term debt. Long-term debt often ties into the property, plant, and equipment. Those two together add up to your total liabilities, or the total debt your company owes. And then the owner's equity is exactly what cash you put in. And depending upon if you make or lose money in a given year, your equity goes up. And one of the things I'll just give each of you as a quick aside, and one of the things our firm consults with clients on, is that your ultimate goal when you pass your company on, as we all will one day, is to have your equity build up to be significant to sell your company at a profit, or to pass it on and be able to clip coupons, some kind of dividend, some kind of payment, because you built a value that somebody else can then earn a cash flow stream. We've talked about this, total assets equal total liabilities. Once again, this is a pictorial that what you owe, what you get is in the equity. Total assets are all the assets of value. One of the things I will mention, there is a such thing called goodwill. We're not going to cover that today, but that's essentially once you do get your company to be worth something beyond the value of just the hard assets there, because these assets do depreciate over time. The hard assets do. Once again, we're talking through current assets, fixed assets, notes receivable, advance payments. Those are inventory. Many times you have parts and supplies that add up to inventory. Those are all part of the assets. Accounts receivable, notes receivable, assets list, in order of liquidity, which is an important concept. Liquidity is another word for nearness to cash. You know, how quickly can you get the money out of it if you need it. The reason that's important because you have to write a check periodically to pay bills, to pay staff, etc. And you often invest in contracts because you actually start doing the work and you know you bill in the arrears on time and materials is usually a basis. Prepaid expenses, I've mentioned that. So these are your current assets. Every company is a little different in what falls into those specific categories. Fixed assets, as we talked about, if you have a building, one of the good things about having a business to pay for a building is that one of the assets at the end of your career or later in your career, you have a tangible asset. The risk of that, of course, is that you got to pay the bill every month. If you're renting space or if you're working out your home, yes, that may help on cash flow, but there is a long-term slight disadvantage. But you have to do what's best for you and your company given the situations that you're in. The important concept of depreciation, let's speak a second about that. Depreciation is just something that the federal government has recognized in companies, that when you buy an asset the first day, it's like your car. The value declines over time. And they set up what they call an expected or useful life, a period over which they say it's usable, and then they take and depreciate each year a portion of the total initial cost, and you can expense that to your P&L, because at some point you will have to replace that asset, and you certainly must maintain that asset. Your accountant can help you, but one of the issues that I see often companies have is that they're working an asset so hard that at some point it breaks down and they never set aside funds for both repair and maintenance and ultimately for replacement. Varies per assets. If it's a house, most of you get mortgages from 20 to 30 years. If it's a caliper front-end loader, you know, it depends. There are accounting rules I won't say specifically, but it'll probably be closer to 5 to 10. If it's a desk, if it's a computer, a lot of companies expense computers. They get it 1 year and they just expense it that year. Your policy on that needs to be consistent. But in fact, you can also capitalize certain amounts. Let me take it a little step further because some of you are advanced and I recognize some of you are newer to this accounting area. One of the things you do internally as a company is that you set up a policy, whether you're going to expense it when you buy an asset that year or whether you're going to capitalize it. That means put it on the books and then depreciate it over time. And you set a dollar amount as a limit. So some companies say anything over 1,000, put it on the books and capitalize it, write it off and depreciate it. Some say 3,000, 5,000, 10,000. Once again, it depends upon the company, depends upon the asset. So that's something that each of you may want to keep in the back of your mind too, because those practices have to be consistent. There's leeway, but what you can't do is do it one way 1 year and another way in the next. That's what is so important doing an audit of your indirect rates, is consistency. There's other assets. Notes receivable is a good, sometimes you have somebody who owes you and they set it up on a payment plan, and that could be a note receivable. That brings you up to your total assets. Liabilities. Once again, there's current liabilities. What's that? Well, accounts payable. You have to pay people, and not only your staff, but your rent, your lights, and there's a whole host of things that go there. There's accrued expenses. Sometimes you have payments that come due at a certain time, those expenses. You may have a long-term payment plan, but you have individual payments that come due. The total amount, if you owed $100, but you only may owe $10 a month, well, that $10 has accrued each month. It's the term that they use to describe that. Sometimes there's a short-term note for you to pay. You took an asset of something, somebody gave you a payment plan. It may be a large amount, but the amount that comes due in the short term, as you define it, is the notes payable or current liability. And as I just described, the current portion of a long-term debt. You don't have to pay the whole debt each month, but you do pay a portion. Long-term liabilities, notes payable, and sometimes shareholders invest. One of the things each of you should consider is that when you put money into your company, some put it in as a loan or a note payable. So therefore the company actually owes you that money back, and the goal is for the company to pay you back at some point. If you don't, then you have to write that off. But there's fluctuations, so sometimes that's a tool people have used. And equity is that phenomena called sweat. And essentially what that is that when you start up your company, you're going to put your own money up, and you're going to have liabilities, short and long term. And that equity part is done if you're done through a formal stock process this way. Most of you don't. Most of you just simply put in cash, which would go into retained earnings. But stock and paid in capital are if you are a corporation and you do set up stock. There's an accounting procedure for how that is handled on your books under stock and paid in capital. Cash you put in is retained earnings. And then each current year, depending upon if you make money, your net income is positive or negative, it impacts your equity. It takes it up if you've made money. It takes it down if you did not. We also not only talked about balance sheets, we talked about income statements or profit and loss. There's an income side, and when your income less cost of sales, cost of goods sold. If you're making rulers, for instance, or let me use a better example. If you're providing Caltrans concrete, the income from your sales less the cost of the concrete would be your gross profit. And then if you have operating expenses, another word for that is general and administrative expenses. And those are your overhead. If you do 10 jobs or one job, you still have the rent for the building, you have your lights, there's a certain corporate expense that's incurred. We're going to talk more about the detail of each of these. After you subtract that out, you get to what's called your net operating income. Some cases there's unusual income that happens one time. For instance, if AJ was to take a tractor and sell it, that's not part of his concrete business. That's just a profit on a tractor. And if he made profit on that tractor, it would what they call come in below the line, meaning below the net operating line, and show other income as sale on Caterpillar tractor. And then that becomes your net income. Let's talk about income. Revenue from sales or fees and for your services. It's just basically the money that comes in. Cost of goods sold. There's really some basic components if you're manufacturing some types of product or you use products in the execution of your work. The raw material costs of those products that you're using to get either the sales from the goods or the fees for the service. Whatever raw materials costs you're using. Whatever direct labor that's involved in executing the fees and executing the sales of the goods. And there's other direct expenses. You may drive there, you may have on-site activities and equipment that you're using. That becomes your cost of goods. And another term for cost of goods sold is just cost of services. And many of you are service companies, so you're more putting in direct labor and direct expenses rather than raw materials. Sales less cost of goods or cost of services equal your gross profit. Shows how much the company has made from its core. Basically, this is what you do for a living, and that gross profit is a good indicator. It's important to watch gross profit because you want to see it to be as high as it can. A lot of you kind of look at yourself as a fixed cost. You say, well, I spend 40 hours a week, 50 hours a week. I'm going to spend that whether I do a lot of jobs or a little, a few jobs. But it is good to track periodically, not necessarily weekly, but probably monthly, quarterly, certainly before the end of the year, your gross profit. How much revenue am I bringing in versus my cost of direct sales? Operating expenses come in after your gross profit, and it involves indirect labor. For instance, some of you that have multiple levels of management within your company will have supervisors that may not work on a particular contract. They may supervise a supervisor that's working on a Caltrans contract and another one that's working on a BART contract. That supervisor is indirect labor. He or she are at the corporate level, and they are allocated across the various contracts of which the company participates. There's procedures to do that. As we mentioned earlier, rent and utilities are all overhead items or G&A items or operating expenses, postage, printing. Everybody has to have insurance these days. That gets amortized into your indirect or general and administrative costs. Depreciation is there as well. I want to mention advertising. Small companies tend to advertise minimum. They tend to go to a few seminars, tend to go to a few trade shows. They have business cards. They may have a website. They may do a mailer periodically. They may have flyers. All of that's good, and I would encourage each of you to have that at minimum. There's also other ways to market, because until you have an opportunity for a sale, it's difficult to get a sale. So part of the marketing dollar, or what I call advertising, marketing, sales allocations, shouldn't be overlooked. I truly understand that it's an expense you have to minimize because of cash flow. But on the other hand, if you don't bring in opportunities, it's hard to make long-term sales. Gross profit minus operating expenses equal operating income or profit. Other income, as we talked about, revenues from core operations, less extraordinary income. Interest expense, Once again, those are below. So after you get your basic operating income, then you have from core operations, you may have extraordinary income or an expense. You could have sold that tractor for a profit or actually for a loss because you had to tow it somewhere because it wasn't working. That's an expense of towing that becomes below the line. That's not the regular core operations. And your interest expense, if you do have debt, obviously that goes down here below the line. Operating income plus other income and expense equals your net profit before taxes. And then after you get your net profit before taxes, you got to pay your taxes. And if you are a company, you can distribute a dividend. If there's any money left over after your net profit before taxes and after you pay your taxes, that money is available to the owners. And the way it's done in a corporation setting is called a dividend. And a sole proprietorship is just you distributing funds as you see fit. And it will vary from year to year. Usually the owners have a salary or some draw that they have that's up in the operating direct expenses. But down here you may have a nickel or a dime left at the end of the day to actually distribute as a dividend or a cash distribution to the owners. You can also just take that money and reinvest it back in the company. But the net is, that's the net income or loss for the company. Let's talk about how we set up the financial statements. The goal is to have statements that reflect the true activity on a timely basis for your company. And when you bill Caltrans or BART or any of the public entities, they're required, because they have, many cases have federal funds, and the federal government requires that those funds are used according to the goals and regulations that are set up. There's some federal regulation guidelines that we covered them earlier this week that are fairly extensive. But the bottom line is that the chart of accounts becomes the roadmap by which you collect and account for all the revenues and expenses within your company. You will have a chart of accounts that identifies assets, liabilities, capital, income, cost of goods sold or cost of services, expenses, and other income. So all of these we've already talked about. Let me just share what came up briefly, a cash versus what they call accrual basis. Cash basis is that any monies that come in and expenses that are incurred during a time period are recorded in that time period, usually on a monthly basis. Accrual is a little different. You have to take the revenues that you're billing and you have to recognize, even though you may bill it this month, it may come in this month or it may come in next month. Hopefully it won't come in the month after that. But let's just say it spans 2 months. In accrual basis, you recognize it when it actually hits the books, when it actually happens as opposed to when you book it. There's a basis of how you're calculating, and your accountant will help you a lot more. I'm very much simplifying it, but you should know there is a difference in how you set up your books of cash versus accrual, and work with your accountant on the specifics of what's best for your business. The end of the year becomes a particular issue because sometimes revenues and expenses overlap years between when they occur and when they're booked and when they're actually cashed in, and your accountant can take you through how to handle that. Now, when you're setting up your financial statements, one of the most important things is that you have to be consistent in your record keeping, because as you know, there's always situations where you have to go back, there's adjustments to be made, and there's errors made on everybody's part. And unless you're very well set up and your records are accessible, you'll find that it takes too much time just to sort out some issues. If a question comes back on your billing invoice and you have your invoice for the last 6 months in one shoebox, it just gets difficult to pull it out and respond in a timely manner without inordinate amount of effort. So The kinds of things that help you set up a good system are your sales invoices. This is when you're actually billing. Your deposit slips, comes in from when you're depositing to the bank. Your paid bills to your vendors, and there has to be good records there. The bank statements themselves, there's a reconciliation that should happen. I would say ideally no less than monthly or so to the bank statements to your general ledger. Make sure that you're on track. Some people don't do it quite that frequently, but that can bring other troubles as well. Canceled checks come in. That's part of the reconciliation to the bank statements and ultimately the general ledger. Payroll records. A lot of you are just simply writing checks out of your general ledger for your payroll. Others have payroll services. There's a whole host of them, Paycheck and the whole gamut. So the question is, you just want to make sure that you're getting the records and you can respond, or someone within your company can respond to questions and thoughts and record it using your chart of accounts in a way that makes sense. There's a whole host of tax reports. If you have employees, I know a lot of the individuals are self-employed, so there may not be a lot of payroll taxes, but if there are, you must, just so that you know, the IRS is very particular about payroll taxes. If you mess that up, you end up paying it out of your own pocket in many cases. So that's one area you don't want to make a mistake in. Also, not only do you pay it out of your own pocket, there could be penalties. Those can be severe as well. You need a good labor charging system. One of the things that is so critical to a bill submitted to not only Caltrans, but to any other public entity, is that you're able to show that the employee recorded the time in a consistent and clear manner, signed off on it, supervisor signed off on it, manager within the company signed off of it. If there's only one or two levels within your company, that makes it easy. But that has to be filed, because those are the hours that get multiplied times some labor rate that kick out the dollars, that kick out to an ultimate bill that you'll be sending in. And of course, you're going to be tracking your accounts receivable and your accounts payable. All important documents in setting up your financial statements, whether it's a balance sheet, income statement, or cash flow. We're going to continue through. My main point now is to make sure everybody's comfortable in what we're saying. We're covering a lot. We're going to talk a little bit about some of why these things are important now. But the fundamentals that we've covered in terms of the balance sheet, the income statement, the cash flow is simply when the money is in, when is it coming, and you're tracking that. The main point I want to make here on cash flow is that a lot of you can be making money on the P&L, but not making money in terms of cash flow to have in the bank to pay a bill. Now, let me explain why I'm saying that. What the P&L captures is that you have sold something, the cost of what it took to sell, and the net difference that you realize as a gross profit to apply against your G&A, which is your overhead, and hopefully have a nickel left over at the end of the day to distribute to the owners. But what that doesn't say is that whether that amount that you sold was paid that month or that week or whatever that period of the P&L was. If you find your accounts receivable, and we're going to talk more about that, growing and growing, it means that you may be selling but money's not coming in. That's the cash flow issue that sometimes makes it very difficult for companies. They're making money, quote, quote, because their P&L shows that, but because of their accounts receivable versus their accounts payable, because remember, you're paying on time too, but if you're paying faster than you're collecting, you can actually have negative cash strain. Okay? Thought I'd throw that in there. Let's talk a little bit about financial ratios. These are the things that help you to monitor the health of your company like we spoke about before. They're meaningless unless you have a standard. You can calculate a ratio, but unless you have something to compare it to, like your prior periods, current ratio this month versus last month, earnings this year versus last year, or earnings versus other companies in my industry. Or quite frankly, if you have the ability to create an annual budget, what's my earnings this month versus what my budget estimate was when I set it up at the beginning of the year. So financial ratios can be helpful. You do need to track it against some standard. We're going to talk about 4 types. There's all types of ratios. If you're in investment banking, they use computer programs to process hundreds of different ratios and track different relationships so that they can try to keep their finger on the pulse of the stock market or commodities market of which they participate. Liquidity ratios, safety ratios, profitability ratios, efficiency ratios. Liquidity ratios, they're good to highlight your working capital. It's kind of like how much cash and quick cash do you have. It tracks what a lot of people call your stability, your financial stability, because they believe that if you have cash, cash is king, and that you can react. You can go out and get a good deal on a piece of equipment or something that you need. Whereas if you don't have the cash, you can't do that. Plus you stay ahead and maybe you could take advantage of discounts on early payment. It measures your capacity to pay your debts as they come due. The working capital ratio, simply current assets minus current liabilities, working capital ratios. This should be a positive number. It represents a short-term unencumbered, or let's say the lack of debt against the cash, because you back out what you owe against that which you have. Of course, the bigger the number, the better, and obviously you would want this to be as big over time as you can get it. What does happen in reality, and I've seen it swings up and down. It can be negative at times because we all get paid in lump sums usually. So it's not to say worry, but to learn the relationship of time and track accordingly. Current assets over current liabilities, usually 1. If you got up to 2, that would really be good. Current ratio, current assets over current liabilities. Quick ratios adds in accounts receivable with cash and puts that over the liabilities. Generally, 1 is good. 1 to 1 is good here. Liquidity ratios continuing. Inventory, I don't think I heard a lot of you having major inventories, but inventories over total current assets minus total current liabilities. It's the percentage of your working capital made up of inventory. So if this is like a working capital number, then you get your inventory, you can see the percentage relationship. The number is usually will be less than 1. Another safety ratio that my team has provided for you to consider is the debt to equity ratio. You've probably heard this a lot when you go finance a home. Banks are very big on it. Basically, it's your amount of debt, which is your liability side divided by your equity. And they want to make sure that you don't have so much debt that you're out of place. 1 to 1 is to 4 to 1 is, 4 to 1 is really good. Depending upon the company, because it does vary, there's a lot of variations here, and each company should adapt these to your own specific case and track accordingly. But that debt to equity is something that's usually very important, and particularly when you're going out to get financing, like lines of credits and credit cards and those types of things. Profitability ratios, your sales growth equals your current sales over last year minus last year's sales divided by last year's sales. So the idea is to always have your current year have greater than last year's, and then that net number over last year's sales is the percentage increase of which you had year to year. Profitability ratios continuing. Gross profit margin divided by total sales. Once again, we know gross profit margin is your sales minus your cost of goods divided by sales gives you this profit, gross profit margin. And you can do the same thing. Once you back out of gross profit, your G&A, you get a net profit as we calculated and showed before. Divide that by sales, and that's your net profit margin. Those are important to try to watch. It does vary for service companies, particularly if you're small, because it depends. If you got the big check from a big client, then you look really good. If you didn't, the number has less impact. But over time, when you take periods like a whole quarter or a whole year, the basic relationships do begin to show patterns. Operating expense percentage, operating expense divided by sales. You can calculate this as a percent for each operating expense. We probably listed about a half dozen earlier in the presentation. This would give you a calculation of what percentage marketing is of your total sales, or depreciation, or payroll. Very good indicator to track individual expense lines over time. And it just allows you to track them. And you obviously want to make sure that expense doesn't get way out of whack relative to your sales. See, it doesn't stay flat. It does go up, and you just want to stay on top of that. Sales to total assets. Once again, not each of you would be as concerned in most cases with this, because a lot of the A&E firms don't have major asset bases, so it wouldn't quite have the same. Often service companies are simply offices set up with office equipment, and you bring in your sales. But if you do, this is a good indicator. It measures the efficiency of your business. Days and receivables. It depends how you have contracts. Some may be payable in 30 days, some in 60, some in 10. But these calculations will allow you to track over time how efficient the collection of your receivables and your turnover are. Once again, if you're a product company, and most of you are not, there's an inventory, there's inventory turnover. We're going to look at these quickly so that you'll know about it. And when you get a copy, you can copy it now or whatever. We're getting toward the end of the presentation. This is financial calculators that you can go to get additional references on the financial calculation and the ratios that we're speaking about. So I just wanted to make sure that everybody kind of understands those are there. There's also a host of resources on the internet in other places. Feel free and go through them. I have found that for smaller businesses, it's always good for you to know the basic accounting, but the time is well invested in going over your financial work when you do it or when you have someone else do it, so that you know how the decisions are made and what each of your chart of accounts is collecting in costs, so that if it's an issue and it still represents your true operations, continue. But in some cases, if things change over the course of your business, you can change with it. And you don't want to keep recording in your chart of accounts, in your financial statements, and reporting numbers that maybe should be reported differently because of changes in the business. Well, with that, we're going to kind of wrap up here. A couple of things I want to say from a thank you standpoint. We are going to have an evaluation that's executed to survey your thoughts about that. We want your input. We spent a lot of time preparing. And you can tell my voice is about ready to go, so everything is kind of working out kind of good there. I want to make sure that you are aware that there is a website, www.dbe-advantage.com, and on that website there is a whole host of information about what you can do and how you can do it. And also, I'm going to give you my information at the end, and you can call or email me for any questions. That's very important. Now, there is a service beyond this seminar that you should be aware of. We spoke to it earlier. I want to do it again now, and that is what we call the Business Development Program, DBE Advantage. The services are offered through Caltrans, GCAP services. My partner in this, Bernard Moore and Associates, and several other firms are all pooled together as a project team. And what we're doing is providing these services. There's one-on-one mentoring. There's free technical service for just what your company needs, not only across the board kinds of things, but you may have specific needs. One person mentioned earlier they need their ICR rate looked at. We do that. Matter of fact, I'm working on 2 right now, if I remember correctly. There is a business plan that we actually develop for your business, and that's quite a major contribution there. And I would encourage each of you to consider taking advantage of this. You need to be certified as a DBE. If you're not, we'll help you get that. There's teaming and partnering. Sooner or later, there's going to be primes that are going to be looking at services. You want to get in front of those primes. You want to demonstrate your capability. You want to join their project bid team, and you want to get to work and do it. That's why you're here and in business. There's the access to the recorded webinar, which we're doing now, and others, and there's valuable business resources. There's also a level of bid matching. We've actually, within our capability, helped match your SIC code type things or the kinds of functions you provide to the contracts that are coming out. That in itself is very valuable. So once again, there's services here at these 2 websites. There's an email support helpline, so to speak, through this email as well. I hope each of you can see that. We're Bernard E. Moore and Associates. I'm Ray Moore. We're consultants to management, and that's our phone number, our email, and our website as well. So you have a lot of resources here. You have Caltrans, you have GCAP, you have R. Moore and Associates. I look to hopefully work with you in the future. Best of luck in your accounting and understanding financial statements.